Welcome back to the channel. In today's video, we are going to talk about one of the most visually intuitive and widely used tools in technical analysis, candlestick patterns. If you have ever looked at a stock chart and wondered what all those colored bars and shapes mean, this video is going to make everything crystal clear. So let us get started. Section 1. What is a candlestick? A candlestick is simply a visual representation of a stock's price movement over a specific period of time. That period could be 1 minute, 1 hour, 1 day, 1 week, depending on the chart you are looking at. Each candlestick tells you four critical pieces of information: the opening price, the closing price, the highest price, and the lowest price during that time period. The wide part of the candlestick is called the body. If the closing price was higher than the opening price, meaning the stock went up during that period, the body is typically shown in green or white. This is called a bullish candle. If the closing price was lower than the opening price, meaning the stock went down, the body is shown in red or black. This is called a bearish candle. The thin lines extending above and below the body are called wicks or shadows. The upper wick shows the highest price the stock reached during that period. The lower wick shows the lowest price. Together, the body and the wicks give you a complete picture of how buyers and sellers battled it out during that time period. Section 2. Why candlesticks matter. Candlestick charts originated in Japan over 200 years ago, developed by a rice trader named Munehisa Homa. He discovered that markets were influenced not just by supply and demand, but also by the emotions of traders, fear and greed. Candlestick patterns are essentially a visual map of those emotions. When you learn to read candlestick patterns, you are essentially learning to read the mood of the market. You can see at a glance whether buyers or sellers are in control, whether momentum is building or fading, and whether a trend is likely to continue or reverse. This makes candlestick analysis one of the most powerful and practical tools available to any trader or investor. Section 3. Single candlestick patterns. Let us start with single candlestick patterns, patterns that are formed by just one candle and can give you important signals on their own. The first one is the doji. A doji is formed when the opening and closing prices are almost exactly the same, resulting in a very small or almost invisible body. This tells you that neither buyers nor sellers were able to gain control during that period. The market was completely undecided. A doji appearing after a strong uptrend or downtrend is a powerful warning signal that the trend may be about to reverse. The second important single candle pattern is the Marubozu. This is a candle with a very large body and no wicks at all, or very tiny wicks. A bullish Marubozu means buyers were completely in control from the moment the market opened to the moment it closed. A very strong bullish signal. A bearish Marubozu means sellers dominated entirely. A very strong bearish signal. The third pattern is the hammer. This candle has a small body at the top and a very long lower wick, at least 2 to 3 times the length of the body. It looks exactly like a hammer. A hammer appearing at the bottom of a downtrend suggests that sellers pushed the price down significantly during the session, but buyers came in strongly and pushed it back up. This is a bullish reversal signal. It suggests the downtrend may be ending and an uptrend could be beginning. The opposite of a hammer is the shooting star. This candle has a small body at the bottom and a very long upper wick. It appears at the top of an uptrend. It tells you that buyers pushed the price up significantly during the session, but sellers came in and pushed it back down. This is a bearish reversal signal. It suggests the uptrend may be ending.
Section 4. Double Candlestick Patterns. Now let us look at patterns formed by two candles together.
The bullish engulfing pattern is one of the most reliable reversal signals in candlestick analysis. It consists of two candles. First, a small red bearish candle, followed by a large green bullish candle whose body completely engulfs or covers the previous red candle. This pattern, appearing at the bottom of a downtrend, signals that buyers have taken over from sellers and an uptrend may be starting. The bearish engulfing pattern is the exact opposite: a small green candle followed by a large red candle that completely engulfs it. Appearing at the top of an uptrend, it signals that sellers have taken over and a downtrend may be beginning. Another important two-candle pattern is the tweezer top and tweezer bottom. A tweezer top consists of two candles with the same high appearing at the top of an uptrend, one bullish and one bearish, signaling resistance at that level and a potential reversal downward. A tweezer bottom consists of two candles with the same low appearing at the bottom of a downtrend, signaling support at that level and a potential reversal upward. Section 5. 3 Candlestick Patterns. Some of the most powerful candlestick patterns are formed by three candles. The morning star is a three-candle bullish reversal pattern that appears at the bottom of a downtrend. The first candle is a large red bearish candle. The second candle is a small candle, either red or green, that gaps down from the first, showing indecision. The third candle is a large green bullish candle that closes well into the body of the first candle. Together, these three candles tell a story. Sellers were in control. Then the market became uncertain, and finally, buyers took over decisively. The evening star is the bearish equivalent. It appears at the top of an uptrend with a large green candle, followed by a small indecisive candle, followed by a large red candle. It signals that buyers have lost control and sellers are taking over. The three white soldiers pattern consists of three consecutive large green bullish candles, each opening within the body of the previous candle and closing higher. This is a very strong bullish signal that usually appears after a downtrend or period of consolidation. The three black crows is the bearish equivalent. Three consecutive large red candles, each closing lower. A very strong bearish signal. Section 6. How to use candlestick patterns practically. Now that you know these patterns, here is how to actually use them in real trading and investing. First, never rely on a candlestick pattern alone. Always use them in combination with other tools like support and resistance levels, moving averages, and volume. A hammer at a strong support level with high volume is a much more reliable signal than a hammer appearing randomly in the middle of a chart. Second, always wait for confirmation. If you see a hammer at the bottom of a downtrend, don't immediately buy. Wait for the next candle to confirm that buyers are indeed taking control before entering a trade. Third, practice on historical charts. Open any charting platform like TradingView and go back through historical price data. Identify these patterns and see how the price behaved afterward. This kind of practice will build your pattern recognition skills faster than anything else. Outro candlestick patterns are one of those tools that once you learn, you cannot unsee. Every time you look at a chart, you will automatically start reading the story that the candles are telling, and that story of fear, greed, indecision, and conviction is ultimately what moves markets. If you found this video helpful, Please like and subscribe for more such content. Thank you for watching and I will see you in the next one.